Good evening, ladies and gentlemen. Welcome to tonight's webinar, where we have with us Mr. Colin Low, Senior Macro Research Analyst at IFAS Singapore, and Mr. Sean Tiao, Senior Unit Trust Research Analyst at IFAS Singapore, to share with you about what's behind the recent market volatility, what our view on it is, and what investors should do about it next. Without further ado, I'd like to welcome Mr. Colin Low to kick off tonight's presentation. Colin, please.
Hi, a pleasant evening, everybody. So I'm Colin, a senior analyst and macro research team over here at IFAS. So today it'll be my pleasure here to talk a little bit more on the topic at hand, which is on the recent market volatility as well as the rising inflation concern. So I think starting things right off, I would like to talk about the global picture. So as shown from this chart right here, you can clearly tell that inflation expectation, which is denoted by the lines right here, showing the inflation forwards of the five-year forward inflation swap. So what this measures is in fact the average inflation over the 5-year period starting in the next 5 years. So the lines here tells us a simple story that rising inflation expectation is a global affair, as we see in major economies, and the magnitude might differ from economies to economies, but the direction is clear, and that is that inflation is indeed rising in global economies. So as a result of this, I think inflation fears are slowly building up, and what we've seen most lately is a massive reaction from the bonds market, whereby there is an aggressive sell-off. And as a result of this sell-off, nominal yields actually rose rather dramatically over the past quarter. So what you can see on the chart on the left is the different maturity of the US Treasury as compared to what we've seen before. So what worries investors right now is not the magnitude of the rates, but is the pace of the growth or pace of the rise of the yields, and particularly the longer dated treasury yields, which is shown on a chart on the right hand side. As you can see, the rise is quite spectacular as compared to what we've seen previously. So that is a result of bonds markets are selling off, and as a result, investors are rather spooked by this action. And if we were to look at things on the other hand, breaking things down into inflation expectation, which is denoted by the break-even inflation, as well as the market expected real rates, which is denoted by the TIPS. So what we find is that real rates is rising alongside the inflation expectation. So what we've seen lately is the fact that real rates are rising with inflation expectation, but in fact have exceeded the rise in inflation expectation. So that itself is causing some negative effect in the equity markets. And overall, that has pushed nominal yields higher and faster. So you might ask, what are some of the negative impacts? I think the most severe one, or the most noticeable one, is a sell-off in the growth name. So I think here I have 3 lines. So the yellow line here is the ratio of the Nasdaq over the KBW Bank Index. So as you can see from the yellow line here, the line is in fact trending downwards. And what it tells us is there is a sell-off in the growth names as well, being represented by the tech stock, and an ongoing rotation to the financials. So that is being denoted by the KBW Bank Index. So that line itself is moving in opposite direction of what we've seen as the US 10-year yield. And on top of that, if you can pay attention to the dark blue line, you'll find the rise in the TIPS yield over the past couple of months. So that itself has, in fact, exacerbated the rotation and the sell-off in the growth names. So not only is the fact that nominal yields have increased, but real yields, in fact, have increased at a staggering pace as well. And that is one of the underlying factors that's driving the sell-off in their growth names. But broadly speaking, like what I mentioned earlier, the yields pace of change is the one to watch rather than the magnitude. So that itself is more of a concern for us than the level where the yield is at. But however, we like to note that for the 10-year treasury, there are several key levels where we are watching now. So right now, the one key level is the 1.7 to 1.75%, which is the consensus expectation for yield to be at the end of this year. And the other one is the 2%. So that itself some of the key levels of yield that we're watching right now. So here I show another slide which shows that the rising yield in fact can destabilize market. So I think to best represent this across asset volatility, here are three lines. So the line number one, which is the move index, so that shows the bond volatility, and the other two lines shows the equity volatility as well as the tech stock volatility. So from the chart here, you can see the rising bond vol actually bleeds into tech stock vol as well as the broader equity vol, and then that itself can signal the fact that hey, rising yields or in fact disturbance in the bond space can spread to other asset class. But broadly speaking, and loosely, we categorize the market's primary concern into three different categories or three different outcomes. So I think those outcomes are what investors or market participants fear the most. So I think that the first outcome, the first fear is that the Federal Reserve tightens their monetary policy. And the second fear is that a rising yield destabilizes markets, and more specifically equity markets. And the last but certainly not the least is the fact that out of control inflation might occur in the near future. So I think these are just some of the market participants' current fear. And over the course of my presentation, as well as my colleague Sean's presentation, we'll try to address the fears and whether it will materialize or not. I think here this slide shows what we expect for the inflation path this year. So I think firstly, before I dive in, I think we have to acknowledge the fact that inflation is indeed rising, as I was shown earlier on for a couple of my slides. I think key thing that is driving inflation now is a mix of both fundamental as well as transient drivers. I think the Federal Reserve, especially Powell, have focused a lot on the fact that inflation is transient. But I think underlying that, beneath that, we do see some fundamental drivers. So let's explore some of these drivers more in detail. And first and foremost, the fundamental inflation drivers, as what we have observed, have been aligning since the second half of last year. So the first key fundamental driver is coming from a cost push inflation. So that is arising from supply bottlenecks as well as your higher commodity prices. I think a lot of you might have seen the commodity prices coming from all your iron ore, and all these have been rising quite spectacularly after especially towards the near end of last year. I think that itself is been feeding through the real economy and coming out in the different price indices. I think the second fundamental driver is the fact that there's a huge demand pressure from a demand side perspective, a huge pressure from the unprecedented levels of fiscal stimulus, and the fact that recently we saw a 1.9 trillion fiscal stimulus from the US. I think that doesn't really help in terms of this situation right here. And moving on, and from a monetary perspective, I think we see a lot of massive monetary injections that's actually raising the money supply in not just US economy, but the major economies in the different part of the world. I think that itself is finding its way into prices, as we've seen through some leading economic indicators. And last but not least, we see a potential US dollar bear market, and that itself might exacerbate some of this cost push inflation into the markets. And on top of that, I think we can break up the year into the first half as well as the second half, where we see a cluster of transient inflation drivers, which are primarily active this year. So I think the first and foremost, I think a lot of people like to talk about it, which is the base effect that is in play in the first half of the year. So we think that is largely true because we saw weak inflation in the first quarter as well as second quarter of last year. So I think that itself will play out for the first half of the year, whereby your inflation readings itself is going to spike. It's going to spike higher than what we usually see, and testing some of the comfort levels of investors. But I think the underlying drivers of that, predominant driver of that, will be your base effect. That is going to artificially change the inflation reading. So I think moving on to the second part of the year, we see more serious drivers that is coming in play. So bear in mind, these are still transient drivers, which we believe are acting up in the second half of the year. So I think some of these examples are the lag impact of the US fiscal stimulus and the 1.9 trillion stimulus, which we believe we'll see that flowing into prices in the second half of the year, and also exacerbating the fact is a faster than expected vaccination progress, especially in the US. I think that is going to speed up the normalization, which leads me to my third point, which is the pent up demand being unleashed in the second half of the year, as well as some of the reopening, not just in the US, but all over the world. I think that external demand will flood into or affect the US market as well. But broadly speaking, we started off the year by having a core PCE level of 1.5%. And I think this core PCE level is a metric that Fed watches closely as its primary inflation metric. So we saw that at the start of the year to be 1.5%, and then we believe at the end of the year our projected number is around 2 to 2.3%. So over the next couple of slides, I will be showing some of these inflation proxies that is pointing to higher inflation. So I think starting right off with price indices. So I think there are several notable price indices in the market. So the first one is the Empire State Business Condition Index, which in fact is measuring the New York manufacturers, and that themselves is a leading indicator for the ISM manufacturing, which makes it the leading indicator for the leading indicator. So this actually tracks very closely with the core PCE as well. So we find that the New York manufacturers are actually paying higher prices lately for their manufacturing goods, and that itself is a telling sign that inflation is going to pick up over the next 4 to 5 months. And I think looking at the broader manufacturer, which is denoted by the ISM Manufacturing Price Index, is telling us the same story again, where we find the majority of the manufacturer around in the US, especially, is seeing or is paying higher prices, and that itself should translate into higher core PCE towards the end of the year. And moving on to the next indicator, which is the small business price plan, we find that, or rather we see a higher pricing plan for small businesses. And bear in mind, these small businesses are in fact the backbone of a US economy, where they can contribute up to 60% of the US economy before the COVID hits. So I think that is something, a significant fact to note. And overall, looking at the price change or the net percentage change in price over the next 3 months, then that tells us that small businesses are planning a price increase, and this price increase, we believe, may truly factor into the real economy and might manifest itself by higher inflation print. So again, the price indices are telling us, pointing to higher inflation. And looking at some of the official projection that's floating around, I think one indicator that one can never get away from is the output gap, because the output gap of pretty much an output gap of above 0% implies that the economy is in fact producing beyond the potential GDP and is at risk of overheating and therefore generating a higher inflation. So what we see is that whenever output gap crosses zero, so being that the economy is overheating, we see inflation topping out. So we saw that in 07, and we saw that in 18. So with what the US Congressional Budget Office is projecting is that the output gap is going to be close by 2025, and that itself is still a far distance away. But no doubt from here on to 2025, as the output gap closes, we do expect higher inflation, rather inflation trending higher as we move over the next course of this 4 to 5 years. And moving on to some of our favorite market-based indicators, I think number one, one of the favorite more real-time market-based indicator that we like is a change in a year-on-year change in commodity prices. And because higher commodity prices will fit into the input costs and therefore be picked up by some of your manufacturers as well as your small businesses. And I think that itself, as shown on the chart on the left-hand side, is also telling us the same story. It is pointing to higher inflation print to come over the next 4 to 5 months. And another real-time indicator we'd like to use is the TIPS bond ETF over the 7 to 10 year Treasury bond ETF. So that tells us, in fact, that inflation protected security actually climbs versus your longer dated treasury, and that itself also is a very sensitive indicator when it comes to inflation. And again, it is telling us the same story. So I think before we look into detail again, so let us take a look at what is the market as well as consensus expecting for inflation. I think from the chart on the left-hand side, which shows the US inflation expectation via the break-even inflation, over the different tenure, we can find that there is something that stands out. In fact, the fact that the shorter break-even rates are actually rising faster than the longer break-even rates. So the relationship is shown more prominently on the chart on the right-hand side, where you can see the spread between the inflation break-even. So in fact, this spread has crossed over to the negative side, which means that the near-term inflation break-even is higher than the longer-term break-even. So in layman's terms, that implies that the market expects a near-term rise in inflation rather than a prolonged longer-term rise in inflation. So the market is also telling us that it can be, they are expecting a 2-year as well as a 5-year kind of higher inflation over the longer-term period. So of course, I think we don't take a word for word or rather data for data that some of this break-even inflation is telling us, but I think that tells us sends out a strong message whereby near-term inflation is expected to rise, but longer-term inflation might remain rather contained. And moving on to what analysts as well as economists are expecting, we find more than, or rather close to 50% of the analysts as well as economists are expecting a core PCE of more than 1.9%. In fact, within the range of 1.9 to 2.1%. So with our projection of around 2 to 2.3%, that puts us at the close to the 55 to 75 percentile of this range. So I think we are definitely on the high side, and we do expect inflation to surprise to the upside versus consensus estimates. But at our conservative estimates, I think we are still in line with what consensus are expecting. So before I move on, let us take a look at what the Feds are in fact expecting from inflation rate. I think some people might find that interesting. So I think yesterday night we saw the latest round of FMOC meeting. So this data is in fact freshly published. So we saw in fact the median expectation for core PCE inflation for end of this year for the Feds is at 2.2%. And the central tendency, which is stripping away the 3 highest and 3 lowest projection, we find the range to be 2 to 2.3%, which is coincidentally the same as our projection. So I think within that, it shows us that a very strong message that traditionally inflation is being targeted at 2%, but moving ahead, I think we might see Fed becoming more comfortable with inflation moving over 2%. So that itself also tells the market another strong message. So with that, I want to sum up some of these key observations that I run through. So broadly speaking, we expect a core PCE of 2 to 2.3% year on year at the end of 2021. And we think that level itself is manageable because for us, we consider high inflation to be typically above 3%. And the reason why we call that, or rather we consider that a high inflation, is because we see after above 3% or a prolonged level of above 3%, we see the real economy starts to overheat, and therefore we also see a lot of derating risk for equity valuation, and that itself is something that is unpleasant, I believe, for many investors as well as for us. So broadly speaking, with a level of 2 to 2.3%, we are still safe, and therefore one of our main conclusions is that we will see manageable inflation in 2021, and at the same time, a low risk of an out of control one. So you might ask why there's a low risk of out of control inflation. I think there are 2 key reasons underpinning this factor, or rather our belief in, and I believe the number one fact, as I was shown in the chart earlier on, is the fact that US output gap is still wide. So we do see ample room before overheating. And the second factor is we see that some of this transient factor in the second half of this year, in fact, takes time to feed into the economy. So I think the numbers itself might climb higher, but we don't see the risk of it climbing at a pace where it's undesirable. And last and final observation is the fact that we do believe there will be heightened macro volatility, particularly in the second half of the year when inflation crosses the 2% threshold. I think when bond yields actually rise higher to reflect that, I think that itself should drive some volatility in the markets. And I think to answer one of the main key worry as well as what we have put earlier on, so we do see low probability of a Fed tightening this year. So we think that the Fed is likely to tolerate a core PCE of 2 to 2.3% under its new inflation targeting framework. I think an important thing to note here from what the Fed said yesterday, I just extracted some key statements. So I think this is something that is really important. So yesterday they said that they are not going to act preemptively based on forecasts, but will wait to see actual data. So that in fact tells me that they're comfortable with seeing inflation going beyond 2%. I think that itself we have established earlier on with one of my slides showing the projections going above 2%. So I think waiting to see the actual data, we might see inflation run beyond 2%, and Fed might be comfortable with that. And also the other key reason why we think that level is being this level of 2 to 2.3% is tolerated is because if you look at the US labor markets, you'll find that it is still rather sluggish, whereby job openings have fallen by a lot in terms of millions, and we see employees on non-farm payroll also fall by millions. So I think that itself is telling us that unemployment is unlikely to hit the maximum level by the year end, which is one of the Fed's prerequisite before it actually changes the interest rate. And with employment currently at 6.3%, I think that might be a goal unattainable by the end of this year. But with that said, we believe that the rate hikes expectation might get pulled forward. And in fact, markets are pricing in hikes as soon as the late part of 2020. So there are two other reasons why I think there will be low probability of Fed tightening. So firstly, when we look at the US itself, I think financial conditions is something important for the Feds. So over the course of the past, even since the COVID hits, I think the US financial condition has been improving and right now remains rather easy. I think a large part of it is driven by a lot of this money printing as well as the quote unquote unlimited QE that's seen that is being enacted by the Federal Reserve. And the other part of it is the fact that we believe growth outlook for the US is improving. And personally, one of my favorite indicators is the ISM Manufacturing Index. I think that itself is also pointing us to a higher US GDP growth for this year. And we believe, or rather we have seen, or we are seeing many analysts revising higher their US growth estimates, especially with the fiscal stimulus coming along. So I think those two reasons, coupled by the fact that unemployment rate is unable to hit maximum level at the end of this year, shows us or lends credence to believe that there will be a low probability of Fed tightening by the end of this year, or rather for this year. And with that, I'd like to move on to my next point, whereby a rising but manageable inflation, when accompanied by higher growth, can be good. So can be good for investors, can be good for asset markets. So we based on the macro house view itself, we believe global growth is expected to improve as we project the cyclical recovery to gather steam across this year. So I think this chart shows briefly the regional GDP forecast, and we believe Asia will be the one a key engine for the global economy for the next couple of years. I think the growth rates broadly for most regions should be higher over the next few years. I think that itself again lends credence to the belief that a rising inflation but accompanied with growth can be good for asset markets. And I think moving on to my next point, I think this is a key theme that we'd like to highlight is the fact that the reflation theme is firmly in place, and the macro picture right now points us to a reflation theme rather than one of out of control inflation. And if you look at some of these classic signals of a reflation trade, we find a strengthening macro backdrop, rising but manageable inflation outlook, as well as a yield curve steepening. All these points us to reflation, and they are classic signals of a reflation trade. So the chart on my right, in fact, shows the relationship between the cycle's over defensive return spread against the forward inflation expectation. So that itself shows that whenever inflation expectation rises, we see a move towards cyclicals as well as, and the cyclical trend continues. So I think that itself is just one key reason why we think the reflation trade will and should carry on. And despite being consensus, this reflation trade itself, we believe will have legs for most part of this year, given two macro views. So number one, like I mentioned, manageable inflation, and number two is the fact that we project a cyclical recovery this year, as I shown, I think, in the earlier slides. So with that, I would like to move on into the playbook for the year in terms of your fixed income as well as equity. So for fixed income side, I think broadly speaking, we recommend an underweight of fixed income relative to equities. So as you can see from the chart on the right-hand side, the investment grade as well as the treasury were hit hard when the yield surged over the past couple of months, and they have indeed become more unattractive relative to your high yield bonds. So the key reason underpinning this relationship is coming from a negative correlation for IGs against inflation, which this correlation actually increases with your duration factor, as we will see in my next slide. And overall, we think that the returns for the year for investment grade could be subpar. And the other thing to note for investment grade is the fact that credit spreads are already very tight, and we believe they are vulnerable to more widening. And I think within the segments itself, we definitely do recommend an underweight for IG bonds relative to high yield bonds. So I'd like to make a point on IG bonds, whereby I use let me use US IG bonds as an example. So if you take a look at the chart on the left-hand side, you'll find a nominal yield for the US IG bond is around slightly below 3%. But if you look at the real yield itself, factoring in the inflation factor that we took from the 10-year break-even inflation, we find that the real yield is in fact flirting with negative territory. That is, for investors, your real returns itself are nearing the negative level once you factor in inflation level of a rising inflation level, so to speak. And if you take a look at the chart on the right-hand side, which shows the return 5-year correlation with inflation forwards, you'll find that, in fact, most of these IG as well as the US Treasury have strong negative relationship with inflation, like I pointed out earlier. And this negative correlation, in fact, increases with the duration. So I think the question next will be for investors is this the end of fixed income? So I think the short answer is no, of course. I think there will always be a place for fixed income. And within that, we do see a preference for short duration bonds. I think short duration bonds itself should do well and will do well in this kind of backdrop. And so we look at some of these major sectors within the fixed income portion, and we screen out some of these fixed income sectors based on duration as well as yield per unit duration. So we find that, in fact, US high yield to us, based on this screening, stands out the most and is most attractive because it not only has a low duration, but it also has a high yield per unit duration, which gives that a buffer when the US Treasury increases, and that itself will not erode away the yield that is being offered by your Asia high yield. And I think to address another pertinent question, so I think that itself is being inspired by the recent Bank of America Fund Manager Survey. So I mean, in that survey, they asked what level on the US 10-year Treasury will make bonds more attractive to stocks. So a lot of fund managers, in fact, close to 35% of the fund managers believe that when yields hit 2.5%, they think bonds may become more attractive versus stocks. And that itself might prompt some rotation back into stocks. So I think definitely taking this by a pinch of salt, and this does not mean the end of fixed income, whereby even if the price might face some downside temporarily, but the yield itself over time, if the treasury yield increases more and more, we'll find that the yield factor might remain attractive, and in fact might outweigh the equity risk premiums in the stocks, and therefore prompting this rotation back into fixed income. I think this is something worth noting, and therefore I think investors should not write off fixed income once and for all for now. And moving on to equity, I think the equity playbook is more positive and more rosy, because equities themselves tend to fare better in the environment of rising yield and rising inflation. But within that itself, value and cyclical, as we like to highlight, can thrive further, as we see, as we've seen historically, cyclical and value stock thrive in the early business cycle phase when supported by a reflation undercurrent. So the chart on the right shows the global sector return, the 5-year correlation with the inflation forwards, and you see that the sectors that has the largest correlation are in fact the cyclical or the value sectors. This shows that they tend to perform well with a rising inflation expectation. And in fact, this high inflation sensitivity makes this sector good hedges or even tactical plays within a portfolio. And stepping back and looking things in terms of a sector perspective, a geographical perspective, we find that EM equities in fact tend to benefit in this reflation environment because of their favorable sector mix. And there are two, aside from EMs, you'll find that Europe itself is more tilted towards your cyclical or value. And at the same time, they are also less dependent on your growth stocks, which means there's a lesser derating risk for your growth stock. So from a regional perspective, we tend to favor more of EMs as well as Europe when it comes to this reflation theme. But I think do bear in mind that I think EM might face some headwinds from rising dollar, especially when the yields start to climb. I think the dollar itself might see some short-term reversal. I think that itself might be some of a headwind for EM equities. But in general, our broad outlook for EMs for this year as well as the next year is still rather positive, and it's still a constructive one. So I think that itself should not deter investors from staying away from emerging markets, despite some rise in recent volatility. I think with that, I think I come to the end of my presentation, but do stay tuned as I'll be back for the Q&A section. So thank you, everybody.
Thank you, Colin, for that presentation. Without further ado, I'd like to pass the time over to Sean, who will continue the presentation.
Thank you, Jonathan. Hello, everyone. Thanks for staying with us so far for this webinar. My name is Sean. I'm an analyst at the Unit Trust Research team at IFA Singapore. So today, I'll be sharing with you some fun ideas that you can actually potentially think about when looking at opportunities in the current reflationary environment that we're in. So for my presentation, it'll be split into two parts. The first part, I'll be showing you some perspectives, a different perspective as to what Colin has showed you, but basically it will somewhat echo the same idea that we are in a reflationary environment. And for the second part, I'll go through some of the fun ideas, some of the fun recommendations that we have that you can perhaps bring home, think about how you can actually use them in your portfolio for 2021. So without further ado, let me just begin. So I think what we have, this chart should be no stranger to you. I think Colin is just quite a fair bit. And what this chart basically shows you is that actually with the amount of like the yields that we have seen in the inflation protected securities, we see that it's actually not growth that's leading to higher yields so far. And it's more of like inflation fears that actually market participants are having. As you can see, the blue line of it, blue line on the chart, which basically shows you the expected inflation, it's been rising in a much steeper pace than your 5-year treasury yield. So that is one thing to note, that people are actually in a way front running this reflation theme that's ongoing in the markets right now. But they're not doing it for no reason. There is a fundamental reason as to why they're doing it. And largely, I think it has been because of the increase in commodity prices. So over here, we can look at how the expected inflation of market participants, how it trends along with oil prices, which is denoted by, like for this, we are using the Brent standard. And as you can see over here, like oil prices have been rising alongside expected inflation. And this has a few reasons as to why like oil prices have been rising so much. Number one, I think the supply shortage that COVID has caused in terms of how much oil is being pumped today, it has definitely affected oil supply worldwide. And you put into the fact that the world is actually is still reopening, gradually reopening, and that if you combine this this supply shortage with increasing demand, you can see that it has been very positive for oil prices. And as you know, oil is basically a key commodity for almost every industrial activity, and it's no wonder as to why actually it has been feeding into higher prices that that manufacturers have been paying. So this is a line which is the producer price index. So this is the OECD aggregate. So the OECD basically tracks, I think, about 27 or close to 30 countries across the world. And what they have seen is that manufacturers have been paying more for all the goods that they have been producing, right? And again, this is largely, I think, due to the fact that of this dynamic in of this supply shortage in oil, as well as the rising demand as economies reopen. So another chart that I'd actually like to look at is actually the US 10-year Treasury yield and compare it to the copper and gold ratio. So I like to use it because I think copper is also another major industrial metal that is used in pretty much everything. It's used in buildings, it's used in your vehicles, and used in quite a number of your capital goods, right? So what this copper and gold ratio is actually telling us, or rather is suggesting, is that there is rising global industrial activity, right? And the reaction of the 10-year Treasury yield to this rise in this ratio is actually pretty much normal. So I would say it's not something that that is something that we should be afraid of, because this is coming along with more activity, more usage of copper. And if you think about what happened over the last year, when the pandemic actually happened, you realize that actually a lot of economies, they unleash a lot of fiscal packages, some of which are actually like your construction programs. I think China did that. So again, this could be like a spillover from some of their earlier announced fiscal stimulus packages. So let's look at the returns of all the various markets over the last 6 months. So what we have seen is that your value, your cyclicals, they all love this bear steepener, which again is just a very fancy way of saying that your long end of the treasury yield is rising faster than the shorter end of the treasury yields. So this has been very good for inflation sensitive assets like oil, financials, energy, and your materials. And of course, at the other end of the scale, you realize that, okay, your safer segments of fixed income has been doing bad. Even your gold, which is a traditional safe haven asset, has done badly as well. Now, if we look at currencies, we also see a somewhat similar dynamic where your risk-on currencies, they have done really well. So I think the best performing currency over the last 6 months has been your South African rand. So South Africa is primarily, I think, a metal exporter. So this increase in commodity prices over the last 6 months have been really, really good for the South African market as well as currency. But if you look down the line, you find that New Zealand dollar, Mexican peso, Australian dollar, Canadian dollar, these are also risk-on currencies. They tend to rise alongside a reflationary environment. And so this is one chart that I like to look at because I think it really completes the picture as to what we are seeing. So the blue line over here is actually your MSCI AC World Value Index over the MSCI AC World Growth Index. So basically the performance of your value stocks versus your growth stocks. And what we have seen is that, of course, during the COVID crisis, your growth stocks basically outperform the value stocks as the ratio goes lower. But over the last few months, we have seen that actually the performance has somewhat reversed. Value has started to outperform growth. And this is also captured in their relative earnings compared to each other on a forward basis. So the orange line basically compares value stocks forward EPS versus growth stocks forward EPS. And as you can see, there's actually a fundamental reason as to why value stocks are doing well, as consensus estimates are actually projecting a more rosier picture for value stocks relative to growth stocks. And when you look at in terms of valuation, absolute valuation numbers, you notice that, like how value stocks and growth stocks are priced are pretty much at the extreme ends, which is denoted by this 2 standard deviation line at about close to 0.5. So if you think about the improving earnings momentum that the value stocks have vis-a-vis growth stocks, and you look at the valuation level that they are trading at, you can't help but to feel that there's still room for value stocks to actually run over the next couple of quarters. So right now, having given you guys a very like a proper context background as to the type of environment we're in, I'll be moving forward to some of the fun ideas that you can actually bring home and ponder about. And the first one, I think, is actually your Asian high yield segment, fixed income segment. Like I think what Colin has mentioned, I think within the fixed income world, we think the Asian high yield bond segment is the most attractive out of all. And I think primarily it's because of its attractive yield levels. So this fund is giving you about close to 7.5% on an annual basis, and that it has this very attractive credit spreads, about 400 basis points. So the credit spread is basically how much you're actually being compensated on top of the risk-free rate. So you're actually being compensated about 4% more. So for investors who are actually not so who are actually not that who is not much of a risk taker, right? And you still want to actually take part in this reflationary environment, the Asian high yield bond segment is something that you can actually think about. And another thing that we like about this fund is the fact that it has a very high yield to duration ratio, right? We look at this ratio really just to give us an idea of how much treasury yields have to rise before we actually wipe out whatever yields that we are getting right now. And based on what this fund is suggesting, is about yields have to rise about more than 200 basis points before you actually get nothing out of this fund in terms of yield, right? And if you look at the geographical segment of the fund, we like that, it's not just in China. Like you get access to high yield opportunities in India, Indonesia, Philippines, Sri Lanka. These are generally areas that are, I would say, more exotic, something that you will not be able to actually gain access to easily. So I think from a diversification standpoint, and from the fact that you are trying to gain exposure to a world that's actually reopening, that's recovering, I think this is a very good exposure. And of course, as a high yield bond fund, you realize that a lot of its credits are actually in your Bs and your double Bs, which are basically sub-investment grade credit rating. But of course, I think if we do expect, for example, your economy, your global economy to actually improve, then I think credit risk will be less of a concern moving forward, because of the fact that companies have more cash flow to actually pay back all these bonds. And last but not least, what I like about this fund is because of its small AUM size compared to some of its peer funds. And I think this allows the fund to actually exit some of its positions more easily during periods of credit stress. And of course, credit stress can happen sometimes in periods where we don't expect. So I think this is like a pretty good characteristic to have. Another idea is actually a global equity fund, which is the Nectasis Harris Associate Global Equity Fund. So this is a fund that has quite a strong value tilt, which I appreciate, as you can see from its sector exposure. You see that it actually is heavily underexposed to your traditional growth type of sectors like your information technology. And the fact that it has a strong overweight to sectors like financials, consumer discretionaries, and these are generally your more, I would say, value and as well as more cyclical type of sectors. So from that perspective, I think this fund is positioned to actually do well if this value cyclical rotation continues. And what makes it a value fund is one way to look at it is actually its portfolio valuation metrics. And as you can see, it's generally cheaper than your benchmark, the benchmark being your MSCI AC World Index. On a trailing basis, it's trading about 18 times compared to 23 or 24 times for the benchmark. And one thing to note, which is actually not shown in this chart, but it's actually its overweight exposure in Europe. I'm not sure if you remember the slide that actually Colin shared earlier, but basically from a global equity perspective, you break down all the sectors, you find that Europe is actually a highly cyclical type of market. And the fact that this fund has this overweight exposure to Europe, I think is also well positioned. So the next idea is also from the same fund house, but this time around for US equity. So this is like a global equity fund with value too, but it's for the US. So similar story, we see that it has a very similar type of exposure, and that its high exposure towards these cyclical oriented sectors should boost fund performance, especially if yields continue to go higher in a higher growth environment. Perhaps one concept to take away is that is equity duration, which is the same thing which I've shared with you. They're lower PEs, which means that they are less sensitive to rising rate environment. So another fun idea would be Fidelity China Focus Fund. So this is a fund that was previously recommended for quite a few years, I think from 2016 to 2018 on our recommended funds list. And one reason why we actually recommend it today as a play for reflation is because of its value contrarian approach. Right. This fund has a very, very strong value tilt as a result of its investment mandate, where they actually look for unloved companies, but are trading at very good valuations, as well as these companies, they are simply neglected just because of their characteristics. But the truth is, they still have very good balance sheet strength. They have very good cash flows, right? And I think a broad-based improving earnings cycle, especially in the Chinese equity market, as well as rising growth expectations, not just in China, but also across the world, should actually see this fund outperform because of its exposure towards the more value and more cyclical type of sectors. And as you can see over here, from a price to EPS PE perspective, you realize that the fund is actually trading just at shy of 10 times. And if you compare to its MSCI China Index benchmark, which today is becoming more and more growth-centric, you realize that, it's actually trading about 50% discount compared to the benchmark for the portfolio. So I think from a valuation we did, from a value versus growth re-rating perspective, I think this fund has a lot of potential over the next few quarters. Another idea would be for global financials. So it's no surprise why we like financials, because financials is ultimately a highly sensitive, it's highly sensitive to interest rates because of the fact that they're in the business of maturity transformation, right? They borrow near and they lend on a long end of the maturity term. So generally speaking, when interest rates rise, you find that the profitability of banks or rather financials, they tend to rise alongside bond yields, especially if growth is actually picking up. And if you think about it at a sector level, if you compare the MSCI AC world financials versus other sectors, you realize that they are still quite inexpensive on a relative basis. And the fact that they have this tailwind of a cyclical recovery on their back, I think global financials have also more room to actually do well. So I have two more ideas for you. So these two ideas I would say are the more aggressive ideas, but I think it really spells out, it would be aggressive, but also a good expression of this reflationary environment that we're in. And the first one is actually the Latin America fund, Schroeder ISF Latin American Fund. So why we like it is the fact that because of the makeup of the LATAM economy, it's highly cyclical, it's highly, they are primarily like a commodity exporter. So they tend to do well when prices of commodity increases and that economic activity increases, right? So if you think about it, if you expect actually commodity prices to actually go even higher, then this is actually one region that you can consider. And also, I think Latin America gives you exposure to EM consumers that is outside of China that can actually benefit from this export-driven growth for commodities. And another idea I would say is more towards the edge would be the Fidelity Emerging Europe, Middle East and Africa. So this fund invests in largely your emerging Europe as well as some portions of your Middle East as well as Africa. So again, it's the same story of the fact that I think stimulus-driven demand for goods, vehicles, services globally actually make all these key oil and metal commodity markets very attractive. And if you look at its sector makeup, you realize that it has a lot of exposure to financials, your materials, as well as energy. So for this fund, they're invested, I think, about 30% in South Africa, 30% in your Russia, which is a key oil exporter. And again, this is a very, I would say, a very aggressive take on this reflationary theme that you can actually consider. So this is the summary that I have over here, which sums up, I think, some of our key ideas: Asian high yield, global equities, financials, China, US, Latin America, EMEA. So these are actually ideas that spread across the world. There are many ways that you can actually express these ideas. Of course, these ideas are not all encompassing. They are not the only ones that you can think about. But I think for retail investors, these are actually very compelling ideas that you can consider. So all in all, I think just to conclude my part, I think we think, generally speaking, it's time to actually consider reducing our exposure to duration-sensitive assets, which are your growth stocks, which are your US treasuries, for example, or your assets with basically very long duration, right? But at the end of the day, we don't think that you should go all in on value and cyclical type of oriented funds. Certainly, you should not just change all your entire exposure to, let's say, your JP Morgan China to Fidelity China focus, because at the end of the day, we still like growth, right? But we just want to take a more agnostic approach. We want to have less concentration towards growth type of investments, because growth investing, growth concentration in our portfolio today, they can serve as a source of risk, right? If yields continue to go higher and if earnings upgrades do not follow through. But of course, I personally do believe that with this reflationary environment, we will begin to see earnings upgrades coming through over the next few quarters. So that is still not a worry for me. Right? But at the end of the day, you want to reduce exposure to growth and really have a more encompassing exposure to this reflationary environment that we are going through. So all in all, I think yields and inflation expectations have had a really, really good run. So from here, despite the consensus that yields will actually go higher, just remember that markets don't actually move in a straight line. So from here on, they may actually take a breather. But all in all speaking, we still believe that the medium-term trajectory for yields, as well as inflation expectations, as well as printed inflation, it should still be higher from here on until the end of the year. So now I've come to the end of my presentation.
Thank you, Colin and Sean, and thank you everyone for your kind attention today. We hope the session has been beneficial for you. Now do look out for a special promotion on the funds that have been mentioned tonight. We'll be publishing an article on the fsm1.com homepage very soon. So do go over and take a look, especially if you're looking to also invest in some of the ideas that have been presented today. So do stay tuned to fsm1.com. We will continue to bring you more investment ideas and opportunities. That is all that we have for this evening. Stay safe, and we wish you all the best in your investment journey. Good night.